Hey, good evening. This is Ralph Mendez. We're going to work on Chapter 2 homework. Classify each of the following as an asset, a liability, or an equity. Now, what is an asset? What's a liability? So here's a definition. An asset is a resource that an individual, corporation, or country owns or controls with expectation to provide a future benefit. So assets are reported on a company's balance sheet and are bought or created to increase a firm's value. So the first one, a plant is an asset. Equipment, remember, provide future benefit. That's an asset. Yeah, so probably an asset. What's common stock? Well, that's equity. Stockholders' equity, also referred as a shareholders' or owner's equity, is the remaining amount of assets available to shareholders after all the liabilities have been paid. So let's think of it another way. The equity section is the stockholders' claim on the assets, because the liability, the creditors have the claim on the assets. So if you have $1,000 of assets, $1,000 liabilities, equity, you don't have any equity. But the common stock, you've issued common stock, and that's unpaid, that's unearned capital. You did that by selling stock. But then retained earnings are earnings you earn profits by the sweat of your brow. And treasury stock is where you buy back some of your common stock and hold it in treasury. So asset, what is common stock? Well, it's probably an equity account. So you have the idea now. Well, let's do one more, payable. Here, a payable, it's a liability. It's a liability. What is a liability? A liability is sum a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. All right, so y'all should be able to solve the rest of that one. Identify the normal balance, debit or credit. Now, if that's new to you and you don't know what a normal balance is, the normal balance is whatever side increases the account. So let's take a look at this. This is the left side, or the debit, and this is the right side. So now these assets are increased on the left. So because they're increased on the left, that would be the normal balance. So are there any assets there? Yes. If somebody owes you a note, you loan somebody some money, that's a debit, because that is the side that increases it. Now, if you have a liability or equity, what side do they increase on? The credit. So their normal balance is whatever side increases. Assets increase on the left side, so their normal balance is the left side. Liabilities, equity is increased on the right side, so their normal balance would be on that side. All right. What's the rule for expenses? What about expenses? Expenses increase on the left, so that's normal balance. Revenues increase on the right. Dividends increase on the left. So this is the expanded section, because all these things affect equity. Common stock increases equity. Dividends reduce equity. When you sell something, revenue increases your equity, and expenses reduce it. All right. So expenses. And what do? What side they increase on? So that would be the side, the normal balance. Interest payable is a liability, increases on the right side. So that's the normal balance. Factory is an asset. Fees earned is a revenue. So what about revenue? Revenue increases on the right side. So what's the normal balance? And haircutting revenue. So these are both revenue accounts. Analyzing transactions and preparing journal entries. Now here they want us to use 3 steps. So I'm going to do the first one for you. May 15th, Deshaun Tyler opens a landscaping company called Elegant Lawns. He invests $84,000 in cash and equipment. So 84 of that and 44 of equipment, that's 128,000 of assets. That doesn't mean no liabilities. So it's $120,000 of equity he has, because there's no liabilities. So 84, 140. Okay. Now, how do you say that in a journal entry? Well, you have cash goes up, and the left side always goes first. And then 44,000 of equipment. And this represents, what does he get in exchange? The common stock that says he owns it. And they have to match. The sum of the left side has to match the sum of the right side. So 80 and that, so the left sides add up to the right, and that's how you say that. So there's how they are. Now, I'm going to put it into the T accounts, and this is the steps you're going to follow for each one, okay? I'm doing A, y'all do B, C, and D. The T accounts. So I go to cash, and what was the date? I'm going to put, let's see if this is letter A. Do they give me a date? Oh, May 15th. There we go. So I put here T account, May 15th. Put 84,000, 44,000 of equipment. May 15th. But now look, you have to put the stock on the other side. May 15th. And it's the 128. So let's check our work. Remember, assets equal liabilities. There is no equity. So both sides equal. 128 is equal to 128. This side, assets equals to liabilities plus the equity. There's no liabilities, so they're equal. Then we do the journal entry. That's how we say that. And the left side has to add up to the right side. And the left side always goes first. I'm sorry, there can be one or more. Then we just copy and paste that. So cash, we put it on the left. Equipment, we put it on the right. The left. And the common stock, we put it on the right. All right. Number 4, computing a T account balance. So let's look at this. Let's look at a simple one here. So I put in cash here. 1, 2, 3, 4 on the left. That's deposits. And here's 2 on the right. So what's the balance? That's right, 2,000. That's your balance. Everybody, you see it? I just don't want to use hard numbers. Now here's a liability. You charge on your credit card 1,000, then you charge another 1,000 on your credit card, and then you pay 1,000. So what's the balance? Yeah, 1,000. That's your balance, what you owe on your credit card. Now you don't put them over here on the revenue. We put them somewhere else. 1, 2, 3. What's the balance of revenue? 3. So the left side, you just have to, and the balance goes on whatever side's bigger. Now it should be on the left here, and it should be on the right, but you can pay more. Like if all of a sudden, if I want to get ahead on my credit card, I'm going to say, oh, I'm going to pay him 3,000. Well, then my balance is going to be 1,000 on the debit, which means I've overpaid my account. So anyway, but cash, they're not going to let you go negative. So this means you have $2,000 in the bank. All right. So now all you got to do is add up these 3, 4, 5, 540, 540, 540 minus 190, 350. What side did I put it? What side is bigger? So balance is over here. So just do that with all of them, please. 740, and I made a payment on I owed the employee 740. I make a payment of 740. I owe them nothing, my balance. Oh yeah, here's cash. So just add up. All right, now here, this is a little bit different. They have 4 scenarios, and they want you have to put in what you know. Go with what you know, and they want you to solve. You got to solve this algebraically. A plus B minus C plus income minus loss equals this. So equity at the beginning plus the investments minus the dividends plus income minus loss equals at the end. So let's try one. At the beginning of the year, so, and this is hard here. This is a little hard because y'all aren't used to thinking of all these steps. And on top of that, they just tell us the assets at the beginning of the year are 114.5 minus the liabilities 49,086. That means the equity at the beginning of the year is 65,414. Now, remember, assets have to be liabilities plus equity. So what are they at the end of the year? 172 minus 69,660 is 102,340. All right, so now, how did you get from this, and did they give us anything else? Owner made no investments, no dividends were paid. So that means this plus 0 plus the income is equal to the 102. So if I take 102,340 minus 65,414 equals 36,926. Okay. All right. So that's all you're doing. You're going to get. So these numbers stay the same. These right here. And you've got to see on the next one, no investments, but dividends are paid of 1,100. So that's a minus. Dividends are a minus. Okay. Dividends make equity go down. Remember? Over here. Look over here. And this is in your book. This page. A page in your text. Page 50. I'm on page 50 there. And this is what you need to eventually memorize or remember. All right. Classifying accounts. Well, use I for income statement, E for retained earnings, and B for balance sheet. So now let's go look at, so it's asking you where they're at on what financial statement. So I'm going to Yahoo Finance and I brought up Walmart. And as you can see, you click on financials and this is an income statement. There's a balance sheet and there's a cash flow. You don't have the statement of stockholders' equity normally given to you. So on the income statement, look what's there. Revenue, cost of revenues and expense in your operating expenses. The only types of accounts on an income statement are revenue and expenses. So when you go over here, find the revenue. Oh, there's one. There's a revenue, prepaid service fees. There's an expense. There's a revenue, expense, a revenue. So those all go on the income statement. Now, what goes on the balance sheet? Let's go look at, now we're going to go to the balance sheet. And what are they? What's the formula? Assets equals liabilities plus equity. So assets, liabilities, and equity are the only thing on the balance sheet. Where are the assets at? Prepaid insurance. What's an asset? What's an asset? Expenses, no. Expenses are on the income statement. Revenues on the income statement. Salaries payable is a liability. Equipment, that's an asset. Supplies. So you need to figure out where it belongs. And if you have to, go to Yahoo Finance and click on the income statement. And the only thing on there is revenue and expenses. You're learning real things from the real world. All right. Now, this is your first chance to do, it's asking you to do a bunch of journal entries. So let's take a look at them. Rick Mitchell, the owner, invested $140,000 cash. So 140 cash. What else? 15 equipment and 80 equipment. So office equipment and drafting equipment. So please do it one at a time in exchange for common stock. So this is just telling you what's required. So you need to put all these journal entries in here and they will automatically go into the ledger in real life. Now in the class, you're going to have to do it by hand, but watch right now. Nothing's not available. See, there's nothing in that ledger, but let's go do the first journal entry. So cash, what goes first? Things on the left side, the debits go first. Then office equipment. And then drafting equipment. And what did Rick get in return? He put all these assets into this corporation. Well, then he gets the stock, 220, 235, I think. All right, so now we're going to say record the entry. Now watch, let's see if it goes to the ledger. See, there it is. It just copy and pasted them into the ledger. Watch. This goes on the left side, left side, left side, right side. Okay? Left side, left side, left side, right side. See, you always have to be in balance. Asset, asset, asset is equal to the equity. All right? So now do that one at a time. And look what happens. Now the trial balance is populated. A minute ago, it had nothing in it. And then the income statement. Now here what it is, you have to tell it. Remember on the previous problem, you have to tell it revenues, and then you need to put all your expenses. Okay, you're going to have to put all your expenses. All right. And you don't know yet what they are. This is revenues. Do we have one? Revenue. There it is, engineering fees. Do we have rental revenue? I'm going to put that in there just in case we see it. But right now, I don't know if we have rental revenue. But you're just going to go one at a time. When you have big problems like this, you go one at a time. General journal. Oh, let's go back to the problem. The company purchased land worth $59,000 for an office by paying $20 cash and signing a long-term note. All right, so we got to go back to the view the journal entries. Got $59,000. Now, what did you give to get the land? Why does the land go on the left side? Because it's an asset. Now, what did they give? Cash. You paid cash. Did you pay it all cash? No, you gave part cash. And what else did you give? Just a note. Just like when y'all go buy a car, most of us don't have the resources to pay all of it. So we pay a down payment and the rest is on a note. All right, note payable, where are you? There you go. So now 30, 40, 50, 58, 59,000 equals 59,000. And then we say record it. And then we go to the ledger. Oh, look, cash went up on the left, down on the right. So it had 140 minus what you paid down on this land. Now you have 119. See, the computer does the adding and subtracting for you. Still have the drafting equipment. You still owe money. Now you know money on a note. You still have the office equipment. Now you have land, and your equity did not change yet. So that's the way you're going to do this. Now here's your, now remember this, these always got a balance, right? The left side has to match the right side. Now remember on the income statement, eventually your, and then next going to go expenses. And I don't know, let's see. And then where are you going to get all the expenses? Well, you're going to go down the list and see what all the expenses you use. Where would I find them? The ledger or the trial balance will have them too. So far, I don't have any expenses yet. So we do one at a time, one at a time, one at a time. All right. And the next one, this company purchased a portable building cash. Wow. All right. Portable building for how much? Portable, 45,000 cash. So you go back here and we go back to the transaction list. Oops, sorry. Journal entry worksheet, number 3. And portable building. All right. Oh, building and cash. You paid cash. 45,000. 45,000. And this is now like a software program. You say you record that entry and it puts it into the ledger. So now you're going to see that you have land. Now you have a building. Your cash went down twice now. Cash has gone down now. All right. Okay, let's go on to the next problem. All right. Identify type and normal balance of accounts. All right. So now this goes back and you need to study on this page 50 of your text. On page 50 of your text, you need to think about the type of account, and then you've got to identify what is it? Where does it fit? Is it an asset, liability, stock, dividend, revenue, or expense? You've got to classify it. So unearned revenue is a liability. That means somebody paid you in advance and you haven't earned it. What's the balance? The balance is whatever side. Liabilities are increased on the right. So the normal balance is a credit. So it increases on the credit. So whatever side increases it is also its normal balance. Fees earned. What are fees earned? It's a revenue. What's the normal balance of a revenue? Revenue increases on the right, so the right side is the normal balance, and you'll increase on the right. Okay, so now you're going to go down. So this is a liability, equipment's an asset. Okay, equipment's an asset. What's the normal balance? Well, on what side are assets increased on? They're increased on the left side, a debit. So the normal balance, they're increased on the left side, so the normal balance is a debit. So just continuing going down the list one at a time. And if you have to, refer to page 50 of your book, Assets, Liabilities, Equity. There's some of the rules, and here's some more detailed rules. All right. All right, let's go on to number 9. Preparing a journal entries. So here again, you're just practicing over and over journal entry. You put in 7,500 cash. You put in 32.5, 32.50 of photography equipment in exchange. So that's 39,750. And you receive the cash. I mean, common stock, right? Common stock, and you put these assets into the business. So, and now the business can go to work, okay? Because as equipment. Again, they increase on the left, so they go first. And the sum of the left side has to match the sum of the right. How about the next one? The company paid 2,200 cash, so cash is going out, so it goes out on the right side. Well, how do you know? Well, it went up on the left side here, so if it's going out, prepaid insurance is 2,200, and then cash is going out here. All right, what's happening next? The company purchased office supplies. So office supplies is an asset going up. And what did you give to get them? What did you give to get those assets? You gave cash, because it told you gave cash. It didn't say it charged it. If it says on credit or accounts payable, that's like a credit card. All right. The company received cash. So now cash is going up. And why did you receive this $3,300 cash? Because of photography fees. And the last one, you paid cash. So what's happening to cash? Cash is going down, so cash goes down on the right side. There you go. And let's check our work. Okay, so again, there's the rules. Assets go up, cash is an asset, equipment's an asset, prepaid insurance, supplies, cash, and expenses all are increased on the left side. Common stock is an equity increase on the right. Cash is going down here. Cash is going down. Revenue is going up on the right side. Cash is going down. So that's why you have to practice all this to get the rules. Now here, I want you to put these in the T accounts. So let's do the first one. Madison Harris, the owner, invested 7,700 cash on August the 1st. August the 1st. How much cash did she put in? 7,700 and 34.50 of photography equipment. 34.7, I think it was. And again, this is August the 1st. Is that the right number? 34.7 in exchange for the common stock. So this is August the 1st. Or do they want the date? Yeah, August the 1st. So she starts the company 37, 8, 9, 10, 11, 41, 42, 4, I think. Okay, so let's just check our work. Okay, so there's so we do this. So now the left side, right side. Now watch what happens here. You have to put it in here. When you get done, after you've entered these 5 adjustments, so on the next one, you're going to create okay, so right here, the company paid 3,300 cash for an insurance policy. On what day? August the 2nd. $3,300 is going. August the 2nd, $3,300 is going out for what? A prepaid insurance policy. Okay, August the 2nd. What's happening on the 5th? Office supplies for 1,000 cash. On what day? The 5th. So on August the 5th, cash is going out again. And what did you buy? What did you buy here? Office supplies. August the 5th, you bought $1,000. There you go. Now, is anything happening there? No, we're going to have to do something. That's why it's not showing up. It wants us to. Now here, the company received 4531 cash, 4531 for revenue. So what date? What was the date though? I need to put the date. The 20th. So there's August the 20th, and here's so on August the 20th, we did work, 4531 work, and they paid us. Now you notice how these things are doing the math, the balances. You see the balances? Okay, one more and then we show it. Then you paid $795 on the 31st. So on August 31st, you paid your utility bill of $795, and it goes to utilities expense, August 31st, $795. So now watch what requirement 2 is. Now look, here's the balance, 7136. 7136. So you just have to put in the balances. What's the balance of office supplies? $1,000. What's the balance of prepaid insurance? $3,300. Now they have to balance. If photography equipment is $34,700. Common stock, how much is the common stock? $42,400. What side is it go on? How much was the photography fees earned? And what's your utilities expense? $795. Now we need to balance, or we have a mistake somewhere. We balance. So let's check our work. So we did our trial balance, right? See, a trial balance is nothing more than the balances. So accounting's hard, but don't make this step hard. A trial balance is just the balances at a certain time and date, okay? Now, it didn't, so I just should have put no date there at all. Somehow that I got that put in there, okay? 11, entering transactions into T accounts. So y'all should know I'll do one here. Created a new business. Number 1 on cash, 6,400 cash, 7,700 of equipment, 13,700 in web servers. Okay, in exchange for what? What'd you get? The common stock. So how much does that add up to? 6,400 plus 7,700 plus 13,700. 27,800. I hope I added right. Oops, wrong. 27,800. Now this is crazy. A minute ago they had the date on the inside. Now they got on the outside. All right, fine. How do we do? Oh yeah, I'm sorry. That was part of 1. I just should have put a 1 there. It's number 1. But a minute ago they had the date on the inside on one of the problems. Okay, so that's what you're going to do. The company paid $4,900 cash in advance for prepaid insurance. So cash is going to go down, and then you're going to have an asset called prepaid insurance. All right, what's next? Again, I'm asking you to practice over and over so that you'll make 1,000 mistakes, and then that's when you'll learn. I'll be glad, so don't be afraid to embrace failure. Record the owner's investment exchange for stock. So 6,700 of cash, 7,600 equipment, 10,800. Oops. So what is this? Cash, equipment, web servers, and then exchange for the common stock. So he doesn't own those, or he or she don't own those assets anymore, but they have stock showing that they own the business. 25,1. And let's check our work. So again, that's what you're going to do now for the others. One at a time. Remember, you're not sure what to do? Refer to the rules on page 50 and reach out to your friends. All right, 13. All right, so let's see what it is. Posting errors are identified in the following table. In column 1, enter the amount of the difference between the 2 trial balance columns, debit and credit, due to the error. The amount of difference between the 2 trial balance columns. Okay, due to the year. In column 2, identify the trial balance columns, debit or credit, with a larger amount if they're not equal. All right, so let's try this. I'm not sure I understand the column 1, but anyway. 5420 is credit to cash, is posted twice as credits to cash. So 5420, and then column with the larger is going to be the credit because you put it twice. It's 2 credits to cash. And then what is going to happen? Cash is going to be, cash is understated because you've subtracted too much. You took it out twice. All right, and I think that's the only thing there. Now 10,000 for debit to dividends is debited to common stock. So there's not going to be anything there because common stock went down, but you didn't mess up. It's not like it's twice or anything. Credit with the larger deal. Account with a larger. I don't think none, either one. Identify accounts incorrectly stated. So you're going to have common stock and dividends are going to be, common stock is understated because you took too much. I'm sorry. Common stock is understated because you debited it, which reduces it. And dividends are understated because you didn't put, common stock's understated and dividends are understated. All right, we'll see if we're right. A 50, 25, 60 debit to prepaid as opposed to debit insurance expense. Well, that's no problem. You still have a debit. So I don't think you don't have any effect there. I don't think. None of those balance. So what's happening here now? So prepaid insurance, let's see, insurance expense and prepaid insurance. So the insurance expense is overstated. Insurance expense is overstated and prepaid insurance is understated because you subtracted it. It's posted as a debit. Oh no. So this one's overstated. Debit to prepaid insurance. So prepaid insurance is, I think it's understated. All right. Debit to machinery is posted as a debit to accounts payable. Wow. So a debit to machinery is posted as debit to accounts payable. So what would the balance be off? No, I don't see it. I don't see anything there. We'll see if I'm wrong. So now what do we have here? So we have 2 accounts, machinery and accounts payable. And what's the effect on accounts payable? There we go. Debit to machinery as opposed to debits to account payable. So this is understated and machinery is overstated. It's overstated. So let's check our work. A debit to machinery. Oh, it's understated because I thought he added too much. So, all right. So now you know what to do with that one. And what do we have here in this last one? Oh, the ratios. So now what they're asking you is the debt ratio. So debt to assets. So take the debt, liabilities is debt to the assets. 135,200 divided by 145 is 0.9324. 0.93. It says round the 2 decimal places. So that's how you do that. Take your liabilities, divide by your assets, and that tells you that they have 93% of their assets are financed by debt. Okay, good luck to you. I hope this helps you. Chapter 2 is a very important chapter, so reach out for help. I hope this helps.